I don't really see any mechanism linking the asset sales to equity market volatility. They, the asset purchases put a little upward pressure on rates, put some downward pressure on rates. The decline puts a little upward pressure on rates, but it's modest, as Lou said.
Do you think the Fed made a policy mistake by doing the third round of quantitative easing?
No, absolutely not. I mean, the Fed was, during that period of time, they were doing everything they could to make sure that the recovery was substantial. The unemployment rate was high. There was a risk of inflation going down.
So you're not in the camp that says today that Powell is trying to clean up the mistakes from Bernanke and Yellen. You're not in the camp like Druckenmiller and Warsh, who wrote that the Fed should have started tightening before and should back off now.
No, not at all. I mean, I think Chairman Powell is continuing the policy of Bernanke and Yellen to wait until there was a robust recovery, and then gradually and with a long, sort of runway of letting people know what they're going to do, wind that down.
Bill, I think it's worth pointing out, and I don't know what's in people's minds. There is no money from quantitative easing that is in stocks.
Directly,
right.
They didn't buy
Directly.
stocks. Yeah.
But it's worth asking you the indirect question. If I went and I no longer have Fed as the buyer of a bond, right? That means some private sector person. And by the way, in the context of rising deficits, another person comes in, right? So all this money is fungible. Does it not reduce the amount of money that otherwise might be available in the stock market to buy equities?
It's true I mean, I agree with everything that you just said, but usually we think of these things as working through expectations. And the Fed's been running down its balance sheet for a year and a half. It's following a path that it telegraphed well before that. It hasn't changed from that path. So there's really no mechanism through which that kind of an effect could happen. Basically, in this case, it's going to be by making longer-term interest rates a little bit higher, so the discount on stocks is going to be a little bit more.
But the sensitivity to risk itself, you have global central banks over the course of the last 5 to 7 years that they absolutely are providing a put to the speculator in that they're going out, they're buying treasuries, they're buying mortgage-backed securities, they're buying corporate bonds in Europe, they're buying ETFs in Japan. That has an impact on risk. It creates almost a riskless environment. And now if you begin to remove that, and you don't really see the economic growth that policymakers long argued for, they always said to fiscal policymakers, we need the handoff. Okay, well, is growth really strong enough globally to make that handoff right now? There's more risk right now as an investor.
So, if you look last year, the Fed, the Treasury, the IMF, and the Office of Financial Research in their financial stability reports all reported that equity valuations were stretched. I don't need to go much farther than looking at that, along with the fact that the economic outlook is a lot less certain and the interest rate outlook is a lot less certain, to understand what's going on in stock markets.
But Bill, here's the problem with some of your argument, which the Fed announced in September 2017 what it was going to do.
Right.
It then proceeded to do it, and the market basically yawned and didn't pay much attention until it did. And in a sense, you can't blame the market for not paying attention, because they didn't. And now all of a sudden, everybody's on this QT thing.
But the pace is picking up, and especially for a 6-month forward.
It's not any more than they had announced. It's exactly what they announced.
But the pace for next year hasn't changed.
It has not changed.
Which is new information as well.
No, it's not. It's
in the sense that they didn't react to market conditions by saying, you know what, we're going to back off.
Except for we went back and found every question, including one by me in September 17 to Janet Yellen, several to Jay Powell, where we raised our hands. We said, excuse me, Madam Chair or Mr. Chairman, do you mean to tell us that you're not going to change the balance sheet in response to the balance sheet pace in response to changing economic times? And they said, no, we're not.
Steve, the street ignored it because you had the tax cuts.
But you still have the tax cuts.
So, Steve,
go ahead, Bill.
Another problem with the story that the asset sales are affecting the equity market is that, if anything, the news has been that the asset sales are going to be shorter than expected, not longer than expected. I mean, the Fed initially projected that excess reserves were going to be down to a level ultimately of about $500 billion, meaning that these sales were going to continue. Right. Now, $500 billion is
they ain't going there anymore.
Yeah. But that's, that would have been through 2023, 2026. There's a lot of signs in financial markets, as you guys know now, that suggest that they're getting to a point where they may have to stop relatively soon if they want to keep conducting policy the way they have.
And by the way,
here's one thing that I wonder. There's a difference between saying the pace hasn't changed and that balance sheet is not monetary policy. So, sure, the pace hasn't changed, but are you saying the balance sheet shrinkage is not monetary policy?
So actually, I'm not saying either. So I'm saying the news is actually that the shrinkage is going to be less, not more.
So you're saying it is
And
policy,
so if
it does matter?
Well, I'm saying two things. One is you can't point to news about the balance sheet runoff and say that runoff is hurting stocks because the runoff is going to be greater than expected. Because it's actually going to be less than expected.
Yeah.
And of course, the balance sheet is monetary policy, but the Fed has done everything it can to say, look, this is going to be in the background. We're going to use interest rates as our key tool for monetary policy.